Welcome to another S&P 500 analysis. In this analysis, we will look at a key level the S&P 500 is approaching. Last week has been a very interesting week. The S&P 500 along with the rest of the market took some big hits. And the S&P 500 is approaching a key level that we will discuss in this video. We will look at the stock market internals along with the sentiments and see if last week's sell-off is the beginning of a major correction. And as usual, we will analyze the S&P 500 price action and put forth some potential price movement scenario for us to monitor in the coming week. Before I begin, I need you to smash that thumbs up for me to help me promote and share this video on YouTube. And if you are new to this channel and find the contents to be useful, don't forget to subscribe. Thank you for your support. Now let's take a look at the big picture on what the S&P 500 has done for the month of October. In this monthly chart of the S&P 500, we see it bump up against the upward trend line of this megaphone channel and got rejected and ended the month with a loss of 93 points or 2.77% with an inside candle. But from last week's sell-off, we felt the S&P 500 lost more than 2.77% for the month. Looking at this weekly chart of the S&P 500, we could see why we felt it has lost more than 2.77%. Last week's price action took out all the gain from the beginning of the month and more. The S&P 500 started the week with a gap down and has a range of 207 points and lost over 195 points or 5.64% in 1 week. Last week was a wipeout for October. We also see the 10-week moving average and the 40-week moving average are turning down, with the weekly price continue to be in one time framing down and close below the 10-week moving average. That tells us the weekly trend is down. And more importantly, the S&P 500 is coming down near a key level of 3,200, which we will discuss after we have reviewed the sentiments and the market internals to get some context on the market. Starting with the VIX, it finally broke out from the neutral zone between the 20 and the 30 level, and it's been sitting in this zone for almost 2 months, and now it is up at the 40 level. Fear has definitely came back into the market. And the put-call ratio also shot up above the 0.75, and it is up at the 0.9 level. Protection are definitely being bought. Are all these fears being reflected on the internals? Let's look at the New York Stock Exchange up-down volume ratio. On Monday, the gap-down sell-off was accompanied with a minus 10.1 up-down volume ratio, 10 times more down volume than up volume. On Wednesday, another huge sell-off day, and the up-down volume ratio was minus 7.23, 7 times more down volume than up volume. But then on Friday, what happened on Friday? The S&P 500 lost 40 points or 1.21%, and the New York Stock Exchange up-down volume ratio is only minus 1.4, not even 1.5 times more down volume than up volume. Is the smart money buying into this sell-off? Interesting question. Let's look at the daily advance and decline and see what it is telling us. On Monday, 2,410 more decliners than advancers. And on Wednesday, a whopping 2,793 more decliner than advancer. More than 90% of the stock traded in the New York Stock Exchange on Wednesday were down. A total wipeout. Then on Friday, only 688 more decliner than advancers, so what gives? I mean, the S&P 500 is down 40 points. It doesn't appear to have a lot of losers contributing to the 40-point drop on the S&P 500. Definitely interesting. Now for the New York Stock Exchange new high, new low. Not much to be said except we just confirm the recent rally was just mainly coming from a small list of stocks, and majority of the stock have not regained their losses from the pandemic sell-off and have been sitting near the 52-week low. So just a little bit of a downdraft, and some of these stocks will make new 52-week low. we went from around 100 more new highs to around 50 more new lows. So going forward, we need to monitor the new high, new low closely to see how and which way it will expand. The New York Stock Exchange cumulative advanced decline line is showing a small downward positive divergence once again. Is this telling us a dead cat bounce might be coming soon? We'll see. Now let's see if the NASDAQ market is singing a different tune. The NASDAQ up-down volume ratio was 2.47 times more down volume than up volume on Monday's sell-off. And Wednesday it was 2.6 times more down volume than up volume. And Friday was 2.2 times more down volume than up volume. Not very scary number in my mind. Unlike the New York Stock Exchange, where we saw 7 and 10 times more down volume than up volume. Let's see what the story is from the daily advance and decline. 2,254 more decliner than advancer on Monday, and 2,563 more decliners than advancer on Wednesday, and 1,594 more decliner than advancer on Friday. There are approximately 3,600 stocks traded in the NASDAQ market each trading session. So it's like 80% of the stock were down on Monday and Wednesday, and approximately 70% of the stock were down on Friday, with the NASDAQ 100 being down almost 300 points or 2.8%. So is there something fishy going on? I'll give you my thought on this later. Looking at the NASDAQ new high, new low, it spiked with 119 more new lows than new highs on Wednesday, and 84 more new lows than new highs on Friday. But look back on Monday. It was only 25 more new lows than new high. And at one point, Monday was down more than 330 points, or 2.84%. Just like the NYSE, a lot of stocks are barely above the 52-week low. And the NASDAQ cumulative advanced decline line continued to trend with the index. Nothing out of the extraordinary. So here are my takeaway from the sentiment and internals. Fear is definitely back in the market. Protection are being bought. The internal are telling us things are not what they appear to be. Something is fishy going on. Is it smart money betting on a rally after the election? Now let's go and analyze the S&P 500 price action and see what it might do in the coming week. On this daily S&P 500 price chart, we saw a gap down on Monday and broke through the 34.28 support level and proceeded down to fill the gap at 33.06. Now remember what we said last week about the possible downside scenario. We said if it come down and fill this gap and unable to find support from the 33.06 zone, then we could see it move down to the 3,200 level, and that is what the S&P 500 began to do. Now, I've been saying this 3,200 level could be a trend-changing level, and let me explain why I see it as a potential trend-changing level. If we go back, way back to the March low here, and we see a series of higher high and higher low, and until mid-October, the S&P 500 made a lower high. And now if it goes below this 3,200 level, then a lower low would be made. And here's a caveat. Just because it makes a lower low doesn't mean it won't reverse and make a higher high. And this type of price action is what we categorize as a fake out. So let me explain what this fake out is. A lot of retail traders are taught to limit the risk by placing the stop underneath the prior pivot low. And the machine, I call them machine, knows that, and they will go run those stops and shake out all those retail traders before they take the price back up. Now, I'm not saying it will do it this time, but it's a likely scenario. But if the S&P 500 free fall to the 3,200 level, then we'd be looking at the possible support near the next round number, psychological round number level around 3,000, or near this 29.99. You might ask, why am I even bringing this up? I mean, this potential fake out. Because if you recall, when we were looking at the internals, we saw something in the up-down volume that did not agree with the price action. Remember on Friday, there was only 1.4 times more down volume than up volume, with the S&P 500 down more than 40 points. And also the daily advance and decline from Friday did not agree with the price action as well. Remember I said it appears the smart money might be sneaking back in during the Friday sell-off. And if that is the case, then this fake out scenario could materialize. And here are my scenario for next week. I will start on the downside. Looking at the S&P 500, we're looking forward to dip down to the 3,200 level and then back test it. If it fails, then I'm looking forward to proceed down to the 3,000 level and work its way down to fill this gap around 29.55. Now for the upside fake out move, I'd be looking forward to first come and dip down to this 3,200 level and then bounce it back above it and move up to fill the gap at the last Wednesday's gap here above the 33.06, then work toward the 34.28. The other upside scenario is move back above the 33.06 and fill last Wednesday gap and move toward the 34.28.92. If we could overtake the 34.28.92, then we'd be listening to the same old song again and be looking at it to work itself up to this pivot high and toward the all-time high and possibly put in a new all-time high. So those are my scenario for the S&P 500 for next week. Now let's go quickly take a look at the other market indexes. The Nasdaq 100 broke down from the ascending channel and filled the gap at 11,147. The downside scenario for next week is move toward the potential 10,677. If you can't find support there, then the next level to watch is 10,313. We could see the same fake out scenario as I described for the S&P 500. A fake out move below 10,677, then move back up and above it and come back up and back test the 11,147. The other upside scenario for next week is essentially just move back above the 11,147 and get back inside of this price channel. And the downside scenario is dip down to the 10,677, fail the back test, and then proceed down to the 10,313. And last week, the Dow Jones Industrial broke this trend line and came down and filled the gap at the 26,525 and made a lower low. Downside scenarios continue to move down to fill the gap down here at 24,781. The upside scenario is to watch for a fake out move back up above the 26,525 and move up to fill the Wednesday gap above the 27,239. And the Dow Jones Transportation broke the trend line and the support level up here at 11,623. It found support at the gap near the 10,960. We'll watch for a bounce off this level at 10,960 and back up to fill the Wednesday gap near the 11,420. Downside scenario is a continuation move down to fill the gap near the 10,640 level. For the Russell 2000, we were looking for the 1,610 to provide some possible support. As we can see, it didn't hold that support. Instead, it cut right through the next potential support of 1572, then proceed down to the trend line. So for next week, the upside scenario is a possible bounce back above this 1572 and then toward the back test of 1610. The downside scenario for next week is a failed back test of the 1572 and then come down, break the trend line, and move toward the 1432.50. The other downside scenario is break the trend line and head toward the 1432.50 without back testing the 1572. That's the review of the index. So in summary, last week the market has set itself up for next week's election. We can see a major pullback or a bounce from the recent sell-off. Key level for the S&P 500 is 3,200. How it reacts near this level could dictate how the rest of the year will be like for the market. The caveat is how the smart money might be situated for the election. The internals might be telling us the smart money is setting up for a huge post-election rally. It could be a play on the elimination of the uncertainty going into the election. The uncertainties are: 1, if Biden wins, will he win with enough margin that there is no ground for Trump to challenge the outcome? Or 2, Trump wins and nothing has changed and the stock market pump continue. What it really boils down to for the market is, it is not that important who wins, but how the election finished. And maybe the smart money are already betting on a no contested election result after November 3rd. And a big stimulus package will be coming in regardless if there is a blue sweep or not. Now, if the result is tight and there is a challenge from the Republican, then all bets are off and this could drag on until January and we could see a quick unwind from the smart money. After next Tuesday, we might get an idea on how the market will do for the rest of the year. I hope you find this analysis informative and be sure to smash that thumbs up to help me promote this video on YouTube. Thank you for watching and stay safe and be sure to go out and vote.